Good morning friends, I welcome you all in this session. As you might be knowing that in last couple of sessions we discussed market and demand planning of the project. Let us discuss something called financial analysis. When I say financial analysis of the project, you need to look at points like what is the cost of the project, who would be funding that particular project, is project profitable, what is break even point, what is payback period, what is average rate of return, and there are some other points. So, we will discuss all those points in this session. So, the first of all, let us look at ratio analysis. We will quickly go through 4 different types of ratios. So, there is something called return on investment. It's very simple, right? How much you are getting returns on your investments, right? So, this is overall return on overall investment. So, how to calculate ROI? It's very simple, right? It's earning before interest and tax minus tax divided by whatever is your investment. So, this is actually return on investment, right? Return on equity is similar to return on investment, but instead of denominator, rather than investment we write equity, right? So, this measures returns for shareholders. So, it is earning after tax minus preferential dividend divided by equity. So, this return on equity. Now, you have got operating profit margin and net profit margin. So, operating profit margin measures profitability in its gross terms, which is equal to EBIT divided by sales, right? You know what is EBIT? It is earning before interest and taxes, right? Net profit margin is EAT, it is earning after tax divided by total sales, right? So, these are couple of ratios which you should keep in mind. Let us look at what is there in next slide. Okay, this is very important slide, and I am going to ask you a question. If I give you 1000 rupees today or 1000 rupees just after 30 days or next month, which option will you go for? Just think for a while and then reply. 1000 rupees today or next month. Okay, so I think you would have answered correctly, and your answer, I think if it is today, then it is right answer, right? Why today? Why not after 1 month? Because it is very simple phenomenon. The value of the rupee depreciate over a period of time, right? Or you can say because of inflation, 1000 rupees would not remain 1000 after 1 month, right? So, this is your answer, right? Now, if I ask you second question, the second question is 1000 rupees today or next month if interest rate is, let us say 20% per week, what would be your answer? I think now you will change your answer. You should change your answer, right? Because 1000 rupees with 20% interest rate per week would be much higher than inflation rate, right? So, at the end of the day you would be having more money, right? So, this is something called there is something called time value of money, right? So, I am trying to talk about time value of money in next slide, right? So, time value of money is nothing but the money available today is more than money available tomorrow, right? So, this is time value of money. You must be knowing that compound interest is equal to principal into 1 plus r, which is a discount factor to the power n, right? Number of periods, right? So, you can also find out principal from this equation, right, which is equal to compound interest divided by 1 plus r to the power n, right. In other words, you can also write that the present value of the money is nothing but whatever is its future value multiplied by present value factor, right. So, let us say if present value factor is 10%, so and future money is let us say 10,000, right. So, you can find out what is the present value of 10,000 now, right. So, that is known as present value of money, right. So, this is present value factor and R is discount factor and N is number of periods. So, this is nothing but the concept of time value of money, very important. Let me tell you, there is something called capital budgeting. Capital budgeting are there also known as investment appraisals, right. So, is the planning process whether we want to invest our money in some project or not. Let us say the project may be of you want to buy a new machinery, or let us say you want to come up with a new product, or let us say you want to replace your old machines with new machines and such decisions. So, we have to take a call here, should we invest on all these, would that decision would be worthwhile, should we fund those decisions, all these things come under capital budgeting. And capital budgeting can be classified in two broad categories. So, there are several techniques of capital budgeting, there are several ways in which you will come to know whether you should fund a particular project or not, right. So, there are multiple methods and some of them are non-discounting methods and some of them are discounting methods. When I say non-discounting methods, we do not consider time value of money, and these methods are payback period and average rate of return, right. And then there are several discounting techniques. In fact, there are several disadvantages of non-discounting techniques, and because of that you have got discounting techniques, right. Though discounting techniques do have couple of disadvantages, and we will see couple of discounting techniques as well, right. So, you have got discounted payback period, its net present value, profitability index and internal rate of return, right. So, as I said, you have got non-discounting techniques. These techniques do not take into account time value of money, while discounting techniques do take into account time value of money, right. So, we will see these techniques one by one. So, the first one is payback period. So, can you tell me what is payback period? It is very simple, right, payback period, right. So, the period in which you get whatever money you have invested in a project, right. So, it is very simple, right. So, the duration which within which you would be getting back your invested money is nothing but payback period, right. So, we will solve a very simple problem on payback period method. Let us say there is a project and initial investment in a project is 300,000, right. So, initial investment is 300,000, annual cost of operation is 20,000, right. Now, expected annual returns from that project are given here. So, first 2 years you would be getting 100,000 rupees, right. So, you invested 300,000, the first 2 years the revenues are 100,000, and after first 2 years, the next 3 years the returns are 200,000, and the planning horizon is 5 years of. Now, you are supposed to find out payback period, right. So, how to proceed for this? Okay, let me tell you. So, for finding payback period, there is a formula available. right? And that formula is very simple. It is payback period is equal to Y0, the year in which you are getting payback, minus there is something called cumulative cash flow of the year Y0, right, divided by CF1, the cash flow of payback year, right. So, this is year just before this year, right. So, we will solve this question, right, and let us look at this question once again. So, we will solve this question. So, year 0, 1, 2, 3, 4 and 5, right, cash flow. So, initial investment was 300,000, right. So, this is minus 300,000, right, because you have invested, right, this is cash outflow, right. Then revenue in first year is 100,000, right, but you also know that the annual cost of operation is 20,000. So, your revenue is 100,000, cost of operation is 20,000, so remaining is 80,000, right. So, let me delete all these things and let it be like this, right. So, the revenue in first year is 80, right. I have deleted 1000 terms from calculation, right. Next year again revenue is 100,000, but cost of operation is 20,000. So, I am just taking it 80, right. Then you have got next 3 years, what is the revenue? It's 200,000, right, and again annual operation cost is to be subtracted from 200,000. So, this is 180, this is 180 and this is also 180, right, understood. So, initial cash outflow, initial in the first year inflow is 100,000 minus 20,000, similarly here and similarly for third, fourth and fifth year also, right. Now, let us find out cumulative cash flow, right, cumulative cash flow. So, cumulative cash flow is minus 300 plus 80. So, this is minus 220, right, minus 220 plus 80, this becomes 160 or 140, yeah, this 140, right. So, 220 minus 80, so this is 20, then again 60, so this is 140, right. Then minus 140 plus 180, so this is 40, right. 40 plus 180, it is 220, right, and finally 400, okay. Now, let us find out payback period, right. How to find out payback period? We know our formula is Y0, right. So, payback period is equal to Y0 minus its cumulative cash flow in the year Y0 divided by CF1, right. Even cash flow after that particular year, right. So, in this case this is minus 140 and this is 40. So, this is the year just before you are getting positive value, right. So, this is 2, right. Year before payback period, year before where this value is turning from negative to positive, right. So this is 2, right? 2 minus cumulative cash flow for that particular year, right? It means 140. So this minus 140, right? Divided by what? CF1, right? Cash flow after this particular year, right? So this is 180. You can divide this value. So this is 2 plus 140 by 180, right? You can get the answer, and the answer you would be getting is 2.78 years, right? So this is very simple method, and you can also go for interpolation if you are not going for, if you are not applying this particular formula. How to go for that? You know that in this year this is minus 140 and this is 40, right? So how would you do this? Let's say this is second year and this is your third year, right? Now this is minus, let's say this is minus 140 to 40, this minus 140 and this is 40, right? And this is your time, right, from here to here, right? So in 1 year's time this is turning from minus 140 to 40. So total change is what? Total change is 140 plus 40, so 180 is the total change, right? So 180 is the total change in 12 months, right? So in 1 month how much it will change? So you need to find out that particular point where this becomes 0, right? So this is known as interpolation, right? Very simple method. Let us find out payback period for this particular question. How to do this question? This is again a simple one. So you have got cash flow, it's minus 100, 34, 32.5, then you have got 31.37, and finally, yeah, only these values. This is minus 100, 34, 32.5, 31.7, and fourth here it is 30.53, right? So you can now find out cumulative cash flow. So this is minus 100 plus 34, so minus 66, plus 32.5, so this is minus 33.5, plus this you got minus 2.13, and plus this you will get 28.4, right? So how will you find out payback period now? This is the year in which cumulative cash flow is negative and here it is positive, right? So 3 minus, this is 3 minus 2.13 divided by 30.53, right? You will get your answer, right? So very simple method, 3.06 years, right? Let us look at this project. Projected cash flow 30 lakh in first year. Cash flow is going to increase by 10 lakh for next 3 years, right? And then decreases by 45 lakh and closes in 5th year. Initial investment is 140 lakh, working capital requirement is 20 lakh. The company foresees to fetch a net salvage value of 35 lakh after 5 years. Find out payback period. Just go through this question and we will solve this question now. So what is the question? What is the initial investment? It's 140 lakh, right? So this is minus 140, right? And how cash flow is changing? It's 30 lakh in first year and cash flow is going to increase by 10 lakh for next 3 years. So 40, 50 and 60, right? And then what? Decreases by 45 lakh, which is 45, right? So 60 minus 15, this is 45, right? Now in this question you need not require anywhere to use working capital and net salvage value. We would be using those information in some other methods, right? So what is payback period for this question? It's very simple. I think you can calculate very easily. This would be minus 140, this is minus 110, minus 70, minus 20, this 40 and this 85, right? So cash payback period is in between these two, right? So how to proceed this? This is 2 minus 20 by 60, right? You will get the answer, right? It's in third year. Actually, this is the one, right? So this is 3 minus this, right? So payback period for this question is 3.33 years, right? Now let us look at this question, very important question. Compare following projects using payback period method, and you need to select which is the best project and why. So you have been given 3 projects and these are cumulative cash flows, right? So cumulative cash flow for project A is minus 110, for this also minus 110, for this also, right? And 20 for project A in 6th year, 10 here for project B and 20 here for project C. So how to choose the best project? Yeah, what you should do, first of all find out payback period for each of these projects, right? So just try to find out payback period first and then we'll take a decision, right? So the payback period can be calculated like this, right? So cumulative cash flow, okay, so these are cash flows, and this is nothing but cumulative cash flow, right? Just see in this slide, this is cash flow, right? This is not cumulative cash flow. So cumulative cash flow is here, right? So minus 110, minus 90, minus 60, minus 20. So payback period is between 3rd and 4th year, right? Similarly here, right? Is between 3rd and 4th year, and here also between 3rd and 4th year, right? So payback period for first is it's 3 minus 20 by 30, for this also 3 minus 20 by 30, and for this also 3 minus 20 by 30. So payback period is same, exactly same in all these 3 projects. Now how would you decide which is the best project? Now you can see here the cumulative cash flow in project A is 50, here it is 40, right? So we will say that project A is better than project B, right? Because you are getting 10 lakh extra over here, right? Now when you compare project A and project C, which is better? Yeah, project A is better when you compare A and C, right? Why A is better? Because here your revenue is 20, here it is 0. So you can reinvest this 20 lakh and you can get interest for this year as well as for this year, right? So 20 lakh interest can be obtained in these 2 years, right? Similarly, in second year here it is 0 and here it is 30. So again you can earn interest of 30 lakh for 1 year, right? So interest of 20 lakh for 2 years, interest of 30 lakh for 1 year, right. So, project A is the best project out of these 3, right. So, this is what I have written here. A is better than B and project A is better than C, right, because of early recovery, right. So, this is payback period method, right. Now, there are certain pros and cons of this particular method. Its advantage is it's very simple, right. Right, you need not do much calculations over here, right. It's a rough and ready method for dealing with risk, but our focus is and our focus is always on early recovery of the investment, right. So, these are pros and there are couple of drawbacks also, and because of these drawbacks generally we do not use much this particular method, right. So, it does not consider working capital and salvage value, which are two important points, does not consider cash flows after payback period, that's one of the biggest advantages, right. Does not consider time value of money, which one should consider, no consideration of risk, ignores cost of capital, it measures projects capital recovery not profitable, right. So, this is again one of the drawbacks, right. So, let us move on to the next method, which is average rate of return. Now, this is better than previous method because it considers cash flows even after payback period, and also this method considers working capital and salvage value. So, average rate of return is nothing but average return divided by average investment, right. So, for calculating average return, what you should do, whatever are your cash flows, just take summation of those cash flows divided by number of years, right. So, this is average return, right. Average investment is what? It is initial investment plus terminal cash flow, right. And initial investment can be again broken down into two parts, it is fixed investment plus working capital. So, here working capital comes into picture, right, and terminal cash flow is working capital plus salvage value, right. So, if you solve this equation, you will get average investment is nothing but working capital plus half of sum of fixed investment and salvage value, right. So, just keep this formula in mind and calculate average rate of return, right. So, here FI is fixed investment, WC is working capital and SV is salvage value, right. So, we will work out an example using this particular method, right. So, this is basically a question which I would like you to work out, right. So, what is the question? Projected cash flow is 30 lakh, it is the same question which we solved a couple of minutes ago, right. So, projected cash flow is 30 lakh in first year, cash flow is going to increase by 10 lakh for next 3 years and then decreases by 15 lakh and closes in 5th year, right. Initial investment is 140 lakh, working capital requirement is 20, net salvage value is 30 lakh, right, after 5 years. So, you need to find out average rate of return and the formula is already available with you, right. So, I hope you would be able to solve this question. I am not going to solve this question, you just do it, right. So, let us look at one more question. So, you have investment, you have invested in two different machines, machine A and machine B. So, initial cost is 56,125, machine B initial cost is this much, right, 58,125. So, this is your initial investment, right. So, the annual estimated income after depreciation and tax is given over here. So, first year, second year, third, fourth and fifth year, right. So, you have also been given total earnings. So, for this machine total earnings are 36,875, here it is 36,875, same, right. Only the difference is initial investment, right. Estimated life is same for both the machines, estimated salvage value is also same, right. So, which is better investment, that is the question. So, you can solve this question by the method which I just talked about. You can use this particular formula, right. So, calculate average investment, average return, and then divide average return by average investment, right. So, here is the solution for this particular question, and finally we will say that machine A is preferred because average rate of return for machine A is 25%, right. So, this is a very simple question, you can easily solve, right. You can easily calculate average rate of return for these two machines, and for this particular example you would be selecting machine A. With this I complete this session. Thank you very much for watching.